In episode 79, we asked whether it makes sense to own bonds now, since the meager interest you're earning from them is being gobbled up by inflation. Plus, if interest rates rise, current bonds prices will fall. A double whammy. But you might be asking, well, what choice do I have? Today, we address exactly that question, offering 23 possible substitutes that might give you one or both of bonds' main intended benefits, namely a positive total return and a more peaceful portfolio experience. Stay tuned as we discuss all that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm one of your co-hosts, Adrian Nicholson, and I'm joined today, as always, with Roshan Loungani and Erik Olson. It's good that you guys are here. I'm excited for another episode of the Retirement Lifestyle Show. And I just wanted to take a quick moment. We got some interesting stats for our podcast that I think our listeners would like to hear about. So do you want me to dive into that?
Go for it.
I'm not sure.
Yeah.
The first stat that I found interesting is that the Retirement Lifestyle Show has made some new friends in new places, and we got our first streams in 2 new countries. Do you guys want to take a guess on what countries those may be?
Wow. Okay, I'm going to say English-speaking, New Zealand and Australia, because they're so locked down. They've got nothing else to do but to listen to podcasts from the United States.
Erik actually got one right. That's actually really impressive, Erik. Do you want to take a guess, Roshan?
I have no idea. Antarctica.
That's a good guess, but the 2 new places are New Zealand and South Africa. So shout out to those listeners in those places. We really appreciate that. And another interesting stat too is we have a handful of fans who this year the Retirement Lifestyle Show was their top podcast. So we're really thankful, and we hope you've been enjoying our content and been learning new things on how to just overall just improve your plan and your situation that you're in. So I thought that was really interesting to share, and we have another great topic today.
Yeah, that's great news.
I didn't know that. That's awesome.
That is great. So we're going to jump into today's topic. It's going to be a really good one. We're going to be talking about bond alternatives. And this is going to be a really important topic because bonds do have that big role in some portfolios historically. They're a very basic, low-risk solution that investors have usually employed in the past to kind of generate some income and kind of curb the zigzag movements of their portfolio to kind of, stabilize it. They played a really big role. So in this podcast today, we're going to talk to some alternative solutions to bonds. I think is really important because one thing people have really been looking at and taking into consideration today is the current interest rate environment and inflation, where these bonds haven't really been keeping pace with all these different aspects. So some investors are losing several percentage points just holding on to these bonds, where they're looking at other areas where they could deploy their assets. So I think this is going to be a really great topic today, and a really interesting one for us to discuss.
Yeah, completely agree. I think as we go through this list, where we have some of the ideas, some of the bond alternatives we're going to share, to me, the first thing you've got to consider is why you use bonds in your portfolio at all, right? And I start there because there are really 2 purposes that come to mind for me. One is income. So if you're someone that needs to live off the income and you're looking for bonds as an income source, we've got some ideas for you there. The second way I look at it is a diversifier or a hedge against the equity parts of your portfolio. So if you're looking for alternatives, I think where you've got to start is, what are you looking for an alternative for? Are you looking for the income, or are you looking for the diversification aspects or the hedging aspects?
Yeah, that's a really good point that you brought up, Roshan. Just the fact that you brought up the equity piece, how bonds tend to have that inverse relationship with equities. So if the market's like pulling back, even though the bonds haven't been, let's just say, historically been making you money, in an instance where the market's pulling back, these bonds can start making you money on a time where it's hard to make money with your equity. So it's a really it's one of the more important concepts, how the bonds can play a role in the portfolio. But yep, we're going to be having a lot of alternative solutions to bonds. So get your pen and paper ready for this episode, because I'm sure Erik and Roshan are just going to be naming one after the another and just analyzing them to the very end. So I'm looking forward to it. Erik, are you ready?
I am ready. I am very ready.
Erik, start us off. Let's start with we've all come up with lists of some bond alternatives. We've not shared them with each other yet. I'm sure there's some overlap there, but Erik, why don't you start us off?
Well, yeah, I will start us off, but I just also want to add one thing in terms of perspective.
Yeah.
Think about we have over the last roughly 40 years been in a bond bull market, or at least we were through maybe 2010, 2015-ish. In that bond bull market, since there's an inverse relationship between interest rates and bond prices, as interest rates of bonds gradually declined from their immense peak, I think it was the 30-year Treasury, I think was paying 18% per year in 1981 or 82 when Federal Reserve Chairman Paul Volcker did what the Fed could do to try to stamp out the rampant inflation that had characterized the last stages of the 1970s in particular. Over time, as those interest rates came down, bond prices rose. Well, the inverse is also true. When bond yields or interest rates rise, then the prices of those bonds fall. And so when you've gotten as close to zero as we've gotten, while it's certainly true that in some countries they've even gone to negative interest rates, and if the bonds in the United States went to negative interest rates, then those prices would accordingly continue to increase. In this particular case, if you think there's probably not a lot of room in that direction, just probabilistically, there's maybe more room in the other direction of raising interest rates over time. It seems to be the announced intention of the Federal Reserve. So if that has a direct implication for bond prices, we just want to recognize that the regime or the environment for bonds has changed. So that's why we thought, let's talk about some ways of maybe accomplishing some of the same things and heading off what could be a really disappointing decade for bond owners, at least if they do it in the conventional way. So I've got. Let me start off with the first problem that you mentioned, Roshan, which is the portion of the role that bonds can play to serve as an inverse or inversely correlated asset to hedge the movement of prices in the equity arena. And we've noted in previous podcasts that when interest rates are low, there is a price inversity or inverse relationship between them. So this is particularly pronounced in this phase. Bonds actually could play that role to a certain extent. But I think better hedges that aren't quite as vulnerable are available. So I've got the first one I would just talk about is a group that are coming off of options of one way or in one fashion or another. And in fact, I'm just going to start with that. I'm going to use options as a potential bond alternative used correctly. And Roshan, since you're an options guy, maybe you dismiss that, or maybe you think actually there is some opportunity there.
I think there is opportunity there. There's also a lot of risk there. So describe which strategy you're going with in the option space for this.
So I would say if you're using, for example, covered calls on an equity portfolio, there's one possibility. So and we've explained covered calls and we've explained options in more detail in our other episodes. So I would just refer you back to our options episode to get a deeper dive on that. So that's one possibility. Also, the gentle application of longer maturity puts, where you buy the put as opposed to sell the call. I think there's some a role that they can play there too to protect your portfolio overall.
Yeah, so I'd actually want to touch. Let's expand on those briefly. So the covered call, if you've got a stock selling at 50, you sell someone the right to buy it from you at, let's say, 55. They'll pay you maybe maybe 10, 20 cents a share or something like that, depending on the time frame. And that is a solution or an alternative to generating income. The long index put options that Erik just described, that's for the hedging side of the strategy, where a put option, if you're buying a put, what you're doing is you're buying the right to sell something at a specific price at a future date. So theoretically, in that same stock example, if it's trading at $50 and you buy a put that says you can sell it at 45 and that goes out for 2 years, well, if the stock ever drops below 45, you've locked in that you could sell it at 45, but you're going to have to pay money for that put option. Mm-hmm. So whereas the call is an income generating income generating route that you can take, the long-term equity index put is an expense. It's not going to generate income. It's going to cost you money, but it could solve the hedging issue. So I could look at both of those. I always worry about options and risk just because of the way they work, the leverage factor and so on. But those are definitely two ways to attack the bond, or to create bond alternatives for either the income or the hedging aspect.
Yeah, I agree with you, Roshan. That is a good solution. And this tends to be a more active approach when it comes to investing as well, where let's just say traditionally, maybe like if you're close to retirement, you might take on the approach of, let's just say, splitting my money up between 60% in bonds, 40% in stocks, and I'm going to kind of take a more passive approach to this and kind of like hold on to it and adjust along the way, where we're kind of right now presenting a more active way where you can maybe lock in some equities that you own, some stocks at a specific price to kind of hedge your loss or generate income to kind of add a new way to generate that income or stabilize your portfolio from those ups and down movements. So this is more of an active approach versus a passive approach to kind of, yes, you can go.
Finish your thought.
Well, that's what I was saying. This is more of an active versus a passive approach when it comes to solving that role that bonds have played.
I definitely agree with that, and but I would say I think if you're using a covered call strategy and you're in other words, you're selling covered calls and then you are purchasing long dated puts, then I think from a risk standpoint, you shouldn't have something blow up on you. You might have, if you can, especially if you can generate enough income from the sale of the calls to fund the purchase of the puts or come close to it, then you have potentially an ability to have a larger equity position as a total portion of your portfolio, and presumably in the long run, the higher growth rates associated with a higher concentration to equities perhaps also is partially a mechanism for funding your option strategy.
Yeah, that's a good point, Erik. You don't want the kind of safe area of your portfolio or kind of the way you hedge or generate income to kind of blow up on you, because again, this is like the area that we want to kind of curb that volatility in your portfolio and kind of like generate money on this side, I think is important. But it's a really great concept and a really great point that you started off with, Erik. Thank you.
Actually, Erik, I didn't realize that. Were you thinking of you were thinking of doing this together as a pair trade?
Yes, pairing it. Mm-hmm.
Pairing them together. So then you'd have the calls potentially fund the puts as opposed to using the calls for income.
Mm-hmm. At least at some level. So anyway, there was my first. Let's rotate it. Who's got something else?
That's a great one to start off with. Like I said, Erik, I can start off with my first one, unless, Roshan, you're dying to get off the first one on your list.
Please
go
ahead.
You're always excited.
Go ahead.
I will go ahead. The next one that
See, you guys are like Chicago polite here. Come on, I thought you were East Coasters. It was supposed to be let me.
We're not East Coasters. We're DMVers or something.
Oh, DMVers. That's right.
We're our own
the kinder, gentler version of New Yorkers.
Yes, we're our own kind of area. But I'll just dive us into the next one. The one that I kind of researched and looked into how this could kind of play like an income generating portion of your portfolio. The acronym is REIT, REIT, Real Estate Investment Trust. Roshan, Erik, are you familiar with this? Have you ever heard of it?
Yes,
or this is
absolutely.
Brand new?
Very
not brand new.
So REITs, for any listeners that aren't really familiar or just want to know a little bit more about them, these are investments or companies that own a wide array of, they can be rental properties or what have you. Some examples are like office buildings, billboards, medical suites, apartments, data centers, marijuana greenhouses, and cell phone towers. So there are just a lot of different types of REITs out there. And the kind of special like consideration with REITs is that 90% of their profits have to go into investors as distributions or dividends. So that's kind of like the income portion of it. And I guess it's like an interesting area to kind of look at, because I think REITs were kind of like a little bit of a tough pill to swallow recently, because the pandemic really kind of hurt REITs pretty badly, because again, these are just like buildings, and that kind of had its own like thematic event in 2020. But REITs right now are an interesting area to look at if interest rates tend to rise, or if inflation, depending on what inflation does. REITs might be this thing that you can add into your portfolio that can generate income. And the big thing too, they are cash flow. One of the big things with REITs are cash flow. So having that cash flow come in and out can be really useful for your portfolio. What do you guys think?
Yeah, I agree with what you had said with REITs. There are an alternative. There is an important distinction between getting the going and buying a real estate investment trust on the exchange, like whether it's the index or the stock, or looking into some of the private or public-private versions that are out there, like in the alternative space. You'll have a totally different set of investment risk, liquidity issues, and yield. Like if you look on the exchange, I just checked the index as you were going over that. Yields aren't that great. I looked at the index space on the REIT, and the yield is only at 1.86 right now. So you may want to look at some individual REITs. You may want to look at some of the private ones. And as I said at the beginning, consider whether your goal is income or if your goal is the hedging aspects, because the private versus public also play different roles in that from that perspective as well.
And just bear in mind that with the private issuance of those real estate investment trusts, or for that matter, just real estate limited partnerships, that sort of thing, you sometimes have longer tie-ups. So as an example, this is actually, I think, an example of a good one. About January of 2017, some of our clients invested in a multifamily real estate LP, we'll call it limited partnership. And they got about, I would say, close to 80% of their capital back at the 2.5 year mark, and then just now got the balance of their capital back plus 60% of upside. So it turns out in that case, the distributions varied over time, but a nice internal rate of return on that particular in that particular instance. This is not, I'll just say 14, 15 internal rate of return, somewhere in there. So that's not always the case, though. We've had, especially I would say that one thing that happened to a lot of investors, they got really burned by some of the non-traded REITs, and that's a different thing than a real estate limited partnership. They got burned by some of those because what they were sold as these, really high-powered alternatives and not subject to the volatility of the publicly traded REITs. But in fact, what they wound up was being cash cows for the sponsors. And so they were reluctant oftentimes to part with that real estate. And a lot of investors had very disappointing outcomes from it. Yeah. But nevertheless, I do agree that, as you pointed out, there are instances, certainly if you buy at the right time, where that can be very productive.
Also, while we're talking about REITs, let's expand it even further and just talk about real estate in general, right? There is an opportunity there. We had an episode recently that you can check out where we discuss whether we think the real estate market's in a bubble or not. But you have a time right now where there are low interest rates. And if you can find a good property to go out and buy that could be a rental for you, that could serve as a bond alternative from an income perspective, and B, potentially a hedge versus your equities because they aren't in publicly traded markets. So
I was going to say cash flowing real estate is for the people who have the interest and the stomach for that sort of the learning curve that's involved in it. I completely agree with that as well.
Yeah. And, I'll go on, since both of you have added one on the list. I'll just pull one off mine that, this is actually, I'm going to put this out there as the most basic one. I'm sure we'll move on quickly, but I think it gets missed. And that's, from a hedging perspective, cash. Sometimes just having some cash, as opposed to, and let's compare this really briefly to bonds. If you're, as Erik mentioned at the beginning, if you've got we've got a 40-year bull market of bonds. So as he said, rates were coming down for the last 40 years, so prices were going up. If you think rates are going to head up versus come down in the future, which I think is more than likely, well, your bond prices will go down. So the bonds may be paying you income, but you're losing capital. Cash would kind of do the opposite. You're not going to get any kind of good interest rate on it in the bank, so it's not going to give you the income, but you also won't lose your capital. There's definitely a conversation to be had about purchasing power. So I don't think this is a place you'd want to be permanently, but I think a strategic position in cash, or even a few percentage points of the portfolio in cash as you build it out, is something worth considering.
Yes, Roshan, that was actually on my list. I had cash on there, so great minds think alike, as always. But
yes.
I really like some of the points that you brought up. And if you just keep in mind, let's just say you have cash on hand, and the other aspect is bonds. Yes, bonds are maybe yielding a little bit more than cash, but over the long period of time, if there are investment opportunities where if there's like a pullback, it's easier for you to deploy that cash than just deciding which bonds you should get rid of, or if you should like adjust here and there, where cash kind of gives you that built-in flexibility that can be really useful.
Agreed.
Okay. I'm going to go back to my hedging strategy unless you want to say something more about cash.
No, keep going.
Okay. So it's still in the spirit of the two functions of bonds that Roshan outlined earlier, which were A, serve as a hedge against price movement in equities, and B, serve as a source of income. This is still essentially on the hedge side. And I started with talking about options, which is for, if you want to try this at home, it's a little bit tougher deal. But since most people don't have an appetite to take on the learning curve related to options, there are now a variety of tools out there where they've done the work for you. So let me talk about sort of three of them as a group. So one I'll call structured notes, and they also can come in the form of a structured CD. Another is now a family of exchange-traded funds that have deliberately an inverse relationship with the equity markets at some level of either 1-to-1, 2-to-1, 3-to-1. And then a third would be a newer category of tools out there that are essentially buffered, if you will, buffered exchange-traded funds. So every one of those, I think, is kind of interesting. But let me just take a minute and see, guys, have you thought about structured notes, and how would you explain how those work?
Yep, I can jump in on that. So structured notes aren't that easy to explain, just because there's such a huge variety of them. You can get so many options. True. But
in the purest form.
So what you do with the structured note is you can put your money into this note. It's similar to a CD where it locks you in, and you're locked in for a time period. 1 year, 3 year, 5 years. I'm just giving numbers out there, but they're 2 years, you name it. And there's some where your principal's protected, so you can't lose your principal, assuming you hold it to term. However, you can get some exposure to the equity markets, and they have a variety of them. Some of them will be just like the S&P 500, other ones where they'll create their own indices or their own baskets of stock. So if that basket of stock or index goes up, you can get a greater rate of return than CDs potentially. And if it goes down, you can protect your principal. But this is a very basic example. It can get extremely complicated with how they draw these up. And they're not all principal protected. Some have varying levels or types of downside protection or downside risk.
So I think the way of simply
I just
Adrian,
had a
you
quick
wanna-
question.
Sure, go
Just the way Roshan defined it, it seems similar or has certain aspect. Maybe they might be the same, but the way you describe a structured note, is it similar to like a variable annuity where it's like exposure to like equities and not 100% like a variable annuity, but then your principal is also protected? Can you kind of distinguish like the main difference between those? Because what you described, it sounded similar.
Well, no. So with the variable annuity, your principal is not protected, right? So you can lose your principal, and the variable annuity will have potential tax benefits that these structured products don't. So they're
So there's
definitely different.
no tax benefits to structured notes. You said there's a wide variety. I gotta assume there's some out there, or are there none?
If you hold them in an IRA, of course,
Yeah.
any of the consequences of it are deferred. But I think, Adrian, in response to your question, a probably more direct comparison would be not to variable annuities, but instead to indexed annuities, where the index annuity can say, okay, if the markets are down, you'd lose nothing. If the markets are up, you gain something. And that's a similar system with the structured note, except insofar as the structured note usually is built, but as Roshan pointed out, there's many variations on this theme, is usually built to be point to point, whereas in the case of an indexed annuity, it's interval to interval. And so you can have multiple intervals within the defined life of that indexed annuity. But for people who are just saying, I am scared out of my mind, I do not want to lose a penny on this part of my portfolio, then you have the option of obtaining one of these types of tools and using them in the most risk-averse fashion, which is select from that category that has no loss as within the rules. Or you can say, no, I'll trade some. I'll accept some of the downside risk in exchange for more of the upside potential. But these structured notes are essentially a marriage between, in the simplest terms, between a set of options contracts and what's known as a specific type of bond, which is a bond that doesn't pay interest. And so you might say, why would anybody buy a bond that doesn't pay any interest? And it's because you can buy it at a discount up front. And so if, let's say, you throw in $1,000 into this investment, and the underlying bond, because it doesn't have any income on it, you're able to buy at a discount. You might be able to buy the bond itself for, I'm making up numbers, it's not really this easy, but let's say for $900. And so now, after the company that puts this tool together for you maybe takes their $20, you have $80 left to buy these options. So anyway, it's structured notes, I thought, are a way to mitigate some of the downside and potentially have some of the upside.
Yeah, that's how they build it, right? That goes behind the scenes on how you build it. I hesitate comparing it to a CD, but I actually feel like that's probably the closest comparison, just because a CD, you lock your money up for a certain amount of time, you get a fixed interest rate. How this is different, though, is the interest rate isn't defined. Although with the CD, your principal is protected. With these, if you get a principal protected version, they are. So yes, I have looked at these and considered these. They've been, as Erik described how they're built with a zero coupon bond plus options, it's been hard to get some good stuff in this space for really almost since 2008 or 9, as volatility has been really low, which means they couldn't get the options that they needed in a short. So you had to go really long term. Although as the volatility index has gone up, maybe things have changed in the very, very recent short term in that space. But that is an option worth considering, these structured notes. Erik, let's go on to the other two that you mentioned. Let's briefly touch on inverse ETFs and then spend a little more time on the buffered ETFs. I'll just review that. So
sure.
From a hedging perspective, inverse ETFs are exchange-traded funds. So ETF is short for exchange-traded funds. They're exchange-traded funds that do the opposite of an index. And they have a huge variety now, but just as an example, for the S&P 500, you can get an exchange-traded fund that will do the opposite of what the S&P 500 does. That space has expanded a lot over the last 20 years to where now you can get the opposite of the S&P 500, or you can get the opposite of twice the S&P 500 or 3 times. I don't know if there's a 4 times that yet or not, but it can go up there.
But that's the leverage. You can leverage the ETF.
Right. Those are exactly.
I think that's an important aspect of that. I mean, it really just shows like nowadays you can pretty much make money in any type of market environment. For this example, these inverse ETFs, as the market's going down, if you're holding this, you're going to be profitable. So I think this is an interesting area.
This is also very dangerous, which is why I was like, let's touch on this briefly and move on. A couple important points. First is it's the daily. It lines up daily to the index. So what that means is if the S&P was down 10% one year, that doesn't mean if you hold this thing for a year you made 10%. If the S&P had a lot of volatility and moved up and down a lot to get to that minus 10%. It is theoretically possible for it to be down 10% and for you to hold this inverse ETF for a year and lose money. That is possible because of the daily fluctuations. The other thing within these, I don't know if this is still the case at the moment, but they build this using futures contracts, and you have to pay for the futures contracts. So there's what's called a negative roll yield, which means you're losing money just to hold this position. So it's theoretically possible. In my S&P example, it was down 10, you held it for a year. It's theoretically possible that it went straight down 10, but the futures cost so much money that you still lost, even though you were right on your directional call of the market. So be careful with these, is my warning. Anytime we talk about things that use leverage, things that use options or futures, I feel like I'm always throwing that warning out there. And that's probably not going to change. So I hope I don't sound like a broken record. Just be careful.
A leverage quote. So one of you, I think, mentioned in a previous podcast.
Oh, Adrian. Go ahead. Yeah, finish your thought.
Well, I said
Adrian.
One of you in like a previous podcast had like a funny leverage quote. I'm trying to memorize it, but we can just come back to it.
Roshan is the quote master, man. I think he's probably the one who cited it. So
I like that quote master, man.
You know what? I don't remember what that quote was, but I did find one while I was trying to look it up and jog my memory. Let me find. Give me one moment because I liked it. I clicked on it, and this is a Buffett quote. He said, "My partner Charlie says there's only 3 ways a smart person can go broke: liquor, ladies, and leverage."
Okay, well, that's interesting. So I want to just stipulate for our listeners, we have been studiously avoiding mentioning any actual ticker symbols or products or anything like that because for a wide variety of reasons, we're just not trying to promote anything or, for that matter, necessarily disparage anything. But I will say there's a new category of inverse ETFs in particular that fortunately have started to overcome some of this problem of moving in lockstep inversely with the index, and then on top of that suffering from the problem of we call it contango in the futures market and further losing because of time decay. Some of these are specially designed for tail risk moments. So they lose gently while the markets can be rising powerfully. They lose gently during those moments, those phases. But once the big fright gets into the equity markets, these do a really great job of having an equally inverse movement at that time and at that time only. And so from that standpoint, it's a little bit more tenable to hold some of these positions as if not a permanent part of a portfolio in limited quantities, at least to hold it until you have another one of those major beat downs in the equity markets, and then you can release the position until such a time as the markets have reached what you think is a frothy point again, and then you can gradually put that position back on. So, in other words, there's just been some innovations in this category that I think it's worth noting that it's not quite as risky as I would say it formerly had been.
Okay, and let's go on to the buffered ETFs then.
Mm-hmm. All right, so buffered ETFs, this is a really much newer design, which is trying to take the concept of the structured note in one of the variants that we didn't really talk about, which is, when Roshan described the structured note, he talked about in the purest form, the variation that doesn't really entail any sort of downside risk if you hold to maturity. In the case of these buffered notes, they recognize that because of the environment we're in and how expensive options are in relative historical terms, as well as how limited bond yields are, and thus the zero coupon concept is also not as rewarding as it once had been, what they have done is chosen the design that says, look, we'll protect you from some of the downside, and in exchange give you some of the upside. And so the question is then, what's the ratio of that? And one of the product manufacturers, I'm not going to mention which one because there are several of them, but one of the product manufacturers of these issues a new version has a monthly series where each monthly series runs for 1 year. And then in that month, the following year, it resets. And at the point of the reset, they announce what the parameters are for that particular new issue. Now you might think, do I have to sell mine all the time and then sell and repurchase? No, fortunately, the answer is you do not. You're able to just hang on to that. And then assuming that you had 12 positions, one for each of those months, and you just let that thing roll over time, then there's a kind of you're getting the average outcome of each of those monthly series. So I think it's an interesting concept because at least in a bull market, it's had a fairly decent stable return and certainly superior to that of bonds.
Yeah, it could give you that protection as well to the downside, and that varies by the ETF.
And because they're entirely liquid, if you change your mind, unlike with a structured note, you're able to say, okay, I'll just put it up for sale and do something new tomorrow.
Excellent. Let's continue on. I'll put one out there next. Or actually, Adrian, why don't you share one off your list?
Yeah, that'd be great, Roshan. Thank you for that. The next one, I'll kind of give like a little bit of background on this. I think one aspect where we talk about bonds is the interest rate risk aspect of it. I think is really important. So an alternative that can kind of curb this would be preferred stock or preferred shares. I think is a really interesting area that people can look to other than bonds, where this is kind of a bond stock hybrid. So it might be kind of one of the same, but it kind of gives you that. Well, they're very different. They're very like we mentioned before, like the structured notes, there are different types of preferred stock out there where some yields or some incomes can be fixed, some can be floating. Some preferred stocks out there can give you dividend from previous years that I think is interesting. So there are a lot of different characteristics of them. But this is one aspect where you can get some of the growth in the company and also some yield, I think is really important, where you're not at risk most of the times with the given interest rate environment, where preferred shares are more focused on the company's overall credit. So I think this is one area that could be a little bit of a solution to the bond aspect of your portfolio.
Yeah. Do you guys use preferred stocks in your portfolios at all?
I have in the past. I have not used them very much recently.
Mm-hmm.
Yeah.
I maintain a steady sort of a steady model, which I refresh periodically because when there's a buying opportunity, which has both bundles of preferreds in the form of exchange traded funds, but also individual preferreds that I've gone out and really I'm looking for buying them at a deep discount and hoping that and expecting that more of them than will not return to their par value by the point of maturity, or at least at the point of their earliest call date. So I've had I'd say good results with that, and certainly superior to bonds, at least in terms of the total returns on those.
Oh,
yeah,
that's awesome. Yeah.
There was a great opportunity. When I say I haven't in a while, I remember there was a really good opportunity in that space in during that real estate bubble crash time frame.
Mm-hmm.
But I have not seen as big of an opportunity since then.
What happens is, listeners, is these preferred stocks are issued with as Adrian mentioned, they're somewhere between stocks and bonds in the capital structure and of the credit or the issuance of the various securities that these private companies can issue. These stand in between those two categories in terms of their priority of being repaid if something goes wrong with the company. But in exchange for a little less certainty about that than would be true with bonds, you get a little bit more in the way of dividends. But again, because they are more certain than stocks, then you don't get the potential upside. They return to over time, they tend to return to their par value, typically $25 or something along those lines. So what I've observed is that when you have some sort of temporary fright in the markets, for example, when you had what took place when COVID hit, preferred prices, despite their bond-like characteristics, they went down, and that was a great moment, a great opportunity to get in and do some purchasing on some of those preferreds, and then just wait for them to recover. So I love it. I love buying those in those moments of disruption, especially.
Yeah, and a lot of the preferreds are issued by financial companies, and I think that's part of it, right? When you go back to the 08, 09, the financial crisis, well, those were the companies that were hit. So there were great opportunities in the preferred space then. Now, I did not look at them. I wish I had after your description. I didn't look at them when the initial hit came from COVID.
Mm-hmm. Well, probably because you were so busy looking at tech stocks.
Maybe. Maybe. Let's go on the list. I actually will share one that has gotten a lot of news recently. It is limited with what you can do, but do either of you have I bonds on your list?
I didn't, but I had a conversation with clients about I bonds this week, so I feel I'm kicking myself for not including those. Yeah, talk about I bonds.
I feel bad, Roshan, because my list is already done, but I'll keep it going. But no, I bonds was not on my list. Researching this topic, I never even came across I bonds, so I'm curious on what you have to say about this.
Yeah, well, they're Series I savings bonds, and they combine a fixed rate in what they pay you plus the inflation rate. They've gotten a lot of news recently because so the rate adjusts every 6 months, but the recent adjustment comes to an annual yield of 7.12%. So you'll guaranteed to get that rate for half of the term of the I bond. There are limitations to it. It's probably not going to be your whole bond portfolio because you're looking at about a maximum of $10,000 a year that you can put in there. But I thought it was a good one to share with all the listeners.
Yeah, I think it wasn't on my list because we're talking about bond alternatives, and it's a
bond. Yeah,
bond.
True.
So you kind of cheated. So I think we should have a buzzer and buzz you for that.
Maybe while we're on cheating, I've got another one that's cheating then as well, which are tips.
Oh my gosh. Okay. This is for sure cheating. Go ahead.
It is. It treasuries with this inflation protection.
All right.
You can, if you're of the belief that inflation will continue to go rise, this might be another alternative. I will stop cheating and pass it on to you, Erik.
So since you introduced it, tips, Treasury inflation protected securities.
Yes.
I think they outperform treasuries if inflation turns out to be greater than what it was expected to be at the time of purchase. So right now, a number of people who've been sitting on tips are actually pretty happy about that compared to treasuries because inflation has, for buyers of those, let's say a year, 2, 3 years ago, those buyers are sitting in an environment where inflation has outpaced expectations over that time frame. So yes, absolutely. If you can outsmart the rest of the inflationary environment, I think that's a really good choice.
But a key point is where you think we're headed inflation-wise. That's a debate right now where people have strong cases on both sides, right? So
Mm-hmm.
that's for another episode, though. And Eric, I'll let you go on to what you've got
Okay.
next on the list.
Well, yeah.
So I've got two more broad categories, and Adrian, if you think of another one, even though your list is
I have
done,
thought of another one once I said my
Okay,
list was
let's do it.
done.
I will take that as Adrian, go with yours. I think
Okay,
for all of
I will
our
go with mine, Roshan. The one that comes to mind are hard money loans. Does that kind of fit in this, or what do you think about that? That's one I found interesting just to discuss right now.
No, I think that's a great one. I'm going to expand that a little bit and throw a few more in there, and we'll discuss it. But hard money loans is a specific type of direct lending. But you also, I've heard it used most frequently with real estate, where you lend someone money. So an individual will lend someone money that is going to use that to then buy a property. I've seen it most frequently used, the hard money loans when people are looking to buy it and flip the property. But expanding that, if we called that lending in general, just because for time and we're getting through the list, I'll throw two more in there in the direct lending space, or in the lending space. One, what I just said is direct lending. This is where you can go to some of these internet banks and lend money to others, and they've got a whole system set up for you to do this direct lending. And then the other one, just in this loan category, is there are those private loans. When we discussed the real estate, we talked about the public versus private real estate. Well, you have the same thing with bonds and debt. You can lend money most frequently to businesses. There are funds created to do this as well if you want to go the fund route, but you can lend money to them. They don't have the volatility of the market, the public markets, because they aren't traded. So it's just a different risk profile. You still got to make sure your money's protected.
Are the time frames different? Like, because when I was like kind of doing a quick Google search on hard money loans, it was kind of like short term, quick financing, or the time frame can just vary depending on what it is.
My experience with it is each deal is negotiated individually. I don't know of a place where you can just say I have money to do hard lending and they sort of set up a fund. I'm sure it exists actually, but I don't know of any in that space specifically. So the hard lending, private debt, and the direct lending we just touched on. And Eric, why don't you jump into what you have next?
Yeah, so I was talking about this strategy. So listeners, I just blinked out. Thank goodness to my internet here. So what I was talking about was an arbitrage strategy or a market neutral strategy. Since if you're after an attribute that's bond-like in its character, meaning less volatility and some positive return on owning it, historically, strategies like arbitrage and market neutral strategies have been able to accomplish this. So let me explain what arbitrage is just very simply. So there's an observed phenomenon when a company announces that it's going to be purchasing another company. It's not true in every case, but more often than not, the tendency is for the stock price of the acquiring company to not subsequently perform as well as the acquired company's stock. In other words, they tend to have whether they might both move up, but the acquired tends to move up more, or they might both move down, but the acquiring company's stock tends to move down somewhat more. So as a result of that observed phenomenon, then if once such an arbitrage or an acquisition is announced, what you can do is short the stock of the announced acquirer and buy the stock of the announced acquired company, and just allow whether the market generally between those two goes up or generally goes down, capture the convergence of those prices in relative terms. So that's an example of a strategy where we're not talking about huge returns. We might be talking about a 3 or a 4. But if you're looking at a long-term 3 or 4% return on a strategy like that, I think without a lot of volatility, I think that sounds to me more like what you might expect in today's interest rate environment, a good bond outcome to be.
Yeah, that would definitely work. And just for time, I'm gonna go on to a couple others on my list, and Eric, I'll ask you to do the same. But
Sure.
I'm grouping these together intentionally. I guess I could have said them with cash, but gold, defensive currencies. Those are two places where if the market goes down, they tend to hold up pretty well. I'm only adding this in partly because of the name. I should definitely keep this separate actually. So let's pretend I am. But another one is cryptocurrencies as well, worth looking into. The reason I want to keep it separate is because from what I've observed recently, the volatility in there, I question the correlation. The volatility in there seems to be in line with markets. When I've seen the markets go down, I've seen cryptos go down. So defensive currencies are just, you can look at currencies of other countries as a way to protect you, and currency in general, kind of similar to the cash. The gold, also potentially a defensive move. Cryptos, I wouldn't necessarily say are defensive. So I almost want to retract that from this section and move it elsewhere. But Eric, please, you go next. What else is on your list?
So I could wrap up. I mean, you touched on some of the other ones. Private debt was in mine, and there's a couple I can just drop off.
Yeah, drop the names.
Let's market neutral, and in some cases convertible bonds. But that's cheating because it has bond in the name.
Well, if you do it, but if you do that as an arbitrage type strategy, I think it fits. Convertible bond arbitrage. So as Eric said earlier, in this version of arbitrage, you're using a bond that can convert to stock as well as that company's stock, pairing that trade together, buying one, shorting the other, and using that. The other ones, I actually don't think we touched on this. I'll mention it. Dividend yielding stocks. If you do that as a bond alternative, you might want to pair in one of those option strategies Eric mentioned at the beginning with the covered calls and equity puts to try to protect that portfolio, particularly if you're using it for a bond alternative from a hedging type perspective. I think you need to hedge it, but it will give you the income. On my list, I've got two others I'll mention, and then we'll move on, which are commodities and master limited partnerships, or MLPs. And that's it. That's it. Listeners, reach out to us if you want details on those. I'll say, just because we're so over our typical time we target. Eric, is there anything else on your list?
Yes, there is actually.
Please.
And it's all forms of guaranteed income. So I would say Social Security, as an example, can serve as a bond alternative. And that's why if there's a question as to whether should I take my Social Security at 62 or full retirement age, or should I wait till I'm 70, or where should I take it, then while I do believe it's useful to have a case-by-case analysis, and it's connected to your life expectancy and other variables that can affect the answer, how that question is answered. In particular, I would also say the relative ages of two spouses and when it's being considered in a marriage. But the power of having a larger guaranteed income stream takes so much pressure off the rest of the withdrawal rate that one would otherwise need to have on a portfolio of equities in order to make that work. I think it's fantastic. Imagine if you could cover all of your expenses from guaranteed income, then you could allow your equity portfolio to just be strictly there for long-term growth purposes, and you wouldn't have to necessarily hedge so much of the volatility out of concern of having heavy withdrawals on it in a downturn. So that's one. Pensions are another example of this. I had a lady in my office this last week, and she was saying, I'm really, really concerned about this pension. And I tried as hard as I could to persuade her, because she seems like she's in really good health. I tried as hard as I could to persuade her to see the value of keeping it as a pension as opposed to taking it as a lump sum. I failed in that effort, and I failed in that with another client last night where it was, the question was, this is a client who's recurrently coming to me and saying, I'm concerned about this or that. I heard, such and such a talking head say, this or that adverse thing about the markets. I'm concerned. Should we reposition? I'm thinking. So I proposed this idea of your profit sharing plan allows you to take that as a pension instead of taking it as a lump sum rollover into an IRA. Let's evaluate whether or not you could do that, and whether that's, for example, one of the things that we saw, for example, for this couple last night was if they had no inflation adjustment, a 70-year-old man, 74-year-old spouse, they could have about a 6% per year payout for the rest of their lives on that money. And if they started a little bit lower, let's say a 4.5% payout growing at 3% per year, so I would say if they did that with that portion of their portfolio, then the rest of their portfolio could be considered the equity allocation, and they wouldn't need to have bonds there. So guaranteed income, I think, is a very powerful, has a very potentially powerful role to play as a bond alternative.
Yeah, and actually, when you mentioned that, Adrian mentioned this earlier, I'll just point it out. Annuities. You can use an annuity to create a guaranteed income stream, or you could use a fixed annuity to get a fixed rate as a bond alternative. Rates aren't great right now, but they are something worth exploring if you're looking at either of those options. That's 23 items on the list. I've lumped a few together.
You kept count.
Of bond alternatives. Well, I can thank Microsoft Word for keeping count for me, but yes, we've got that. I think we've done a good job covering this topic. I mentioned annuities at the end. We are planning on an episode in the future diving a little deeper into that for our listeners. Please reach out to us if you have questions on these. Some of these are basic and you can go ahead and do them on your own. Some of them I would say seek some advice or do a lot of research before you jump into it.
Here.
Yeah.
Yes, absolutely.
Gentlemen, anything to add in closing?
No, I just want to say to our listeners, if you've listened this far, we appreciate that. And, I would say also, if you've gotten value from this, please let your friends know. Invite them to subscribe to the show as well. And it never hurts for you to go on to your favorite podcast player and give us a review, especially if it's a 5-star review. That does help the show grow. It does help other listeners decide if they want to listen and thereby appropriate the value of what we're bringing to you each week. But anyway, we thank you for listening too.
Yeah,
yes,
check out the website, retirementlifeshow.com.
Lifestyles, Retirement Lifestyle Show.
Yes, retirementlifestyleshow.com. And as Erik said, like, subscribe, 5-star, give us 5 stars, tell your friends and family. We'll be back next week. This has been another episode of the Retirement Lifestyle Show.